In the second part of this video, we are going to talk about, starts with basis of accounting. The basis of accounting is basically refers to the method under which revenues and expenses are recognized in the financial statement. As I said, tell you there are two bases of accounting: cash basis of accounting and accrual basis of accounting. There are other bases of accountings as well. One is called income tax or tax basis of accounting, in which we use IRS method for recognizing revenue and expense. And the fourth one is called regulatory basis of accounting. Railroad and insurance companies uses mostly those. So you don't have to worry about majority of the companies using cash basis or accrual basis of accounting. Cash basis accounting usually used by small company. Large companies such as Microsoft, Google, and Pfizer and Pepsi and Coke, they don't use cash basis of accounting. So what do we do in cash basis accounting? Revenues are recorded only when cash is received. So any cash is coming in will be considered a revenue, and any cash that is paid will be considered an expense. It is very easy to follow and require less knowledge of accounting principles and concepts. But however, it's not allowed under GAAP. It's not allowed. And it's only for small businesses. And accrual basis of accounting is required by GAAP. So any company that is such as a publicly traded company that their stocks are trading on the New York Stock Exchange, they are required to have required to use accrual basis, and you required to use a true GAAP accounting. To measure and report accounting transaction without the necessity that has been cashed or received. So what we are saying that in accrual basis of accounting transaction, every single transaction that has an impact on your financial statement will be required to use by accrual basis of accounting. So for example, if I'm coming to your bakery and your bakery is a publicly traded company that use accrual basis of accounting, and if I give you $500 for the cake and pastry that I want to be delivered at my home 1 week from today, you cannot call that cash or revenue because you have not provided me the cake and the pastry. You will only be able to recognize that $500 cash as a revenue once you deliver the cake and pastry that I'm already ordered. Accrual accounting transactions such as collections, cash from customers. So for example, when do you collect from customer? First, you provide them a product or the service, and the customer promise you that he will pay you later. He or she will pay you later. So the point here is when you have to collect because you have account receivable. So accrual accounting gives basically for account receivable, and later you collect cash on account receivable. Receiving cash from interest earned. So for example, if you have loaned someone some money, they are supposed to give you cash in the name of interest. So when you are receiving the interest, suppose you're receiving the interest at the end of the year, but every month you're supposed to get $500 interest for whatever amount of money. So every month you are going to recognize the revenue for $500 even though you have not received cash, because the other party, after using your money for 1 month, now is obligated to give you $500 every month, even though the cash will give you will be at the end of the year. Paying salaries, rent, other expense. When you are using someone's your employees, you're supposed to give them a salary, but you do not pay salaries every day or every week. You pay them most likely in 2 weeks. So they have to work 2 weeks and then they will receive their paycheck. So during that amount of time, you are accruing their salaries, and their salaries will be paid at a later time. Borrowing money. If you are borrowing money as a business, suppose you borrowed $100,000 from a bank, and the bank told you that you are borrowing this money for a year, so you will be paying $100,000 back to me at the end of the year, and say $12,000 interest at 2. So you will be paying me back $100,000 that you are borrowing today, and the $12,000 interest for the whole year. So the $1,000, 12,000 divided by 12 months is 1,000. So that means your interest expense is $1,000. Even though you are not paying the cash, you need to recognize that interest expense for every month for $1,000. Issuing a stocks, when you're issuing a stock, most likely the money will come within a day or two. So it's not that big deal. So based on two primary principles that we discussed, revenue recognition and expense recognition, also called matching principles. All right. The statement of the next thing we talk about, the statement of stockholders' equity. The statement of stockholders' equity, before we should talk about retained earnings. So when we are talking about retained earnings look like this. So RE is retained earnings. So I'm just using, so here is a beginning balance, you plus the net income. So your net income or your income statement closes into this, and then you subtract a net loss. If you have, either you're going to have a net income or you're going to have a net loss, you cannot have both, and you subtract the dividend. That gives you the ending balance of retained earning. So this is on January 1st and this is on December 31st. All right. So when we are talking about the stockholders' equity, that is what we are talking about in terms of that. So the stockholder summarizes that during the period include the following. So that could be contributed capital, that is common stock, preferred stock, and additional paid-in capital. These are the investment. They also including net income, distribution to owner, which is dividend, any other comprehensive income. I'm not going to into it. Treasury is stock that has the stock that you have sold to the shareholders, and then for some reason you buy it back and keep it in the treasury. Non-controlling interest is also one. So basically what we are talking about, these are the things that goes into the statement of stockholders' equity. Now we're going to discuss the next thing, which is relationship among the statement. So we have income statement and we have balance sheet. With the help of income statement and balance sheet, we basically create retained earnings, which is a statement of retained earnings. And then with the help of these two, we also create a statement of cash flow. So income statement and balance sheet help us create a statement of retained earning, and this income statement and balance sheet also help create a statement of cash flow. So the two fundamental statements are income statement and balance sheet, because income statement talks about revenue and expense, and the balance sheet talks about asset, liabilities, and equity. All right. So net income from the income statement is used to compute ending retained earnings on the statement of retained earning, like I showed you over here. So we know that the statement of retained earning, that's how it's calculated, the ending balance of retained earning, and that ending balance of retained earnings end up here in the equity section of the balance sheet. Ending common stock, retained earnings, total equity from the statement of stock is shown in the balance sheet as I earlier. The ending cash balance on the statement is shown on the balance sheet. So the balance sheet will provide you the beginning balance of the cash, which was on January 1st, and they will provide you the ending balance of cash. So a statement of cash flow, what's going to tell you? It's going to tell you, suppose on January 1, you have a cash 10K, and on December 31st, you have a cash 15K. So the statement of cash flow will tell you this 5K difference, because your cash is increased from 10K to 15K. They will tell you how this 5K changes hands. So they will tell you what happened actually under operations, investments, and financing, and your 5K is changed. Okay. The beginning of period balance sheet shows the company financial position at the earlier point in time, which is this January 1st. The income statement, a statement of stockholder equity, and statement of cash flow report activity for a period. So like I said, a balance sheet provides you a snapshot at a point in time, which is either January 1st or December 31st. income statement, stockholders equity, and statement of cash flow provides you the information for a period of time. So it is from January 1st to December 31st, but balance sheet is provide you time on December 31st. What actually you have in the name of asset, what do you actually owe in the name of liability, or how much equity you have on December 31st. And this ending balance on December 31st becomes the beginning balance on 1/1. We're going to stop here for this video, and we're going to continue in the third part regarding the rest of the chapter.